after the jobs report, you did not, Kristen, change your viewpoint that we get a 25 basis point cut. That's still coming.
And so we're basically expecting that there will be a 25 basis point cut. The market is obviously pricing 100% probability of that. We're really reviewing the data. It almost feels like on a daily basis. So today and tomorrow are critical in terms of what Chairman Powell says and whether there's any guidance that 25 basis point cut is taken off the table. But we believe at this point, given market conditions, it's going to be difficult for them to do that.
We've got, pretty solid GDP. I don't know what it's going to be. A good jobs number. Rates are low and headed lower. I mean, what's not to like about?
I know. There's a lot of data where when you think of the traditional playbook, it's hard, right? Economic data is good. There's everything that we've seen in terms of there's really no clear sign when we look at that traditional playbook for the Fed to cut rates. That being said, the signaling and the market pricing in 100% probability, hawkish surprises have been very rare. So when we look at the percentages, in about 7% of cases versus 80% that the Fed does what the market wants it to do.
Maybe we don't get it, the big picture, and we're so used to being worried. Maybe we don't see that inflation is so low that we're in a place where we can leave rates low and enjoy better economic growth. We got so used to 2% growth, and everyone tells us that's the best we can do. There were times when we did better. Maybe we can't because of population growth and productivity, Jason, but aren't times pretty good? Isn't this a time to stay long, don't you think?
They're quite good. I think the only problem the Fed really has is that you have $13 trillion of negative yielding sovereign debt globally, which is up from about $7 trillion last September. And so it's not a closed system. That's the only problem the Fed really is dealing with, which is to say, I agree with you, Joe, but by the same token, the Fed can't be completely blithely unaware of what's happening in the financial markets itself. And so if you have, let's say if you have an inverted yield curve of 3 months to 2 years, things along those lines, there are structural things that the Fed probably has to do.
Don't say you agree with me, because I'm not saying this. I'm just asking, I'm just making the point. I think I can go to the other side immediately and tell you this is one big, massive central bank orchestrated bubble that all asset bond markets in one, stock markets. I can make that. I read people that believe that very seriously, that we're in territory where the stock market's very vulnerable and everything else. So
as we've talked about before, the dollar winds up really being the governor on the engine for how quickly the Fed can tighten. And I think the Fed might not like to admit it, or other people might not like to admit it, but the president was right. In my opinion, the Fed probably tightened one too many times last year. And I think the market's reaction right before Christmas Eve last year was a pretty good indication of that. The S&P fell 9% in 4 days. So it's probably not bad to, as Larry Kudlow said, take some insurance.
I mean, Greenspan has said that usually the last move in any sort of cycle is a move that was unnecessary. It was one move too far. So if you are of that thinking, as Alan Greenspan is, then that move in December should be taken back and should be sort of negated. But Kristen, I'm just wondering in terms of how you position, because it seems like there's a huge risk that you said it's very unlikely that the markets won't get the cut because Fed funds futures are 100%. That seems like it's the number one risk to this market rally, the market sitting at practically record highs, that we get hawkish testimony, that he starts saying, you know what, because to break the cycle of the markets leading the Fed, Jerome Powell could come out today and sort of walk that back a little bit.
That's really the
it's
only
his
opportunity
right now.
Exactly, because when we look at, okay, we're running out of time, right? So when we look at the economic data, the jobs report, obviously that was almost an argument not to cut, right? And we saw the market adjust, having 50 basis points on the table and then 25 basis points really being the only option. And so right now, the only thing that could talk the markets back is today and tomorrow. So Powell will have to actually signal to markets that we don't need this cut at this point in time. And I think the market is also going to look to the longer strategy, because do we see that a recession is imminent? No. And so we at Citi maintain a bear market checklist where we look across 18 different factors. Right now, only 4 of them are flashing slightly red. And it's the ones that you would imagine. It's basically leverage on balance sheets. It's the inverted yield curve. Everything else is actually quite positive. And to put that into comparison to different markets, in 2000, it was 17 out of 18. In 2007, it was 14 out of 18. And by the way, this doesn't tell us the direction of markets. It just tells you, should you buy the dips? And so it's telling us right now, if we see a pullback, buy the dips.